This video is brought to you by 8% Value Activist Substack newsletter. If you like this video, please subscribe this channel as well as to our Substack newsletter. Your subscription keeps us going, and we thank you for your support. The links are at the end of the video as well as in the comment sections. In our short video today, we will discuss Warner Brothers Discovery, listed on NASDAQ with ticker WBD. We hope to touch on why we like this stock, what happened since we invested, what are the lessons learned, and why was making 126% return agonizing. WBD is one of our portfolio names, and after last week, it delivered 126% return over 2 years. Well, if we had timed it well, it could have been 126% in 10 months. As such, it was agonizing because the stock did nothing for a long time. We shall go into all the gory details in the next few slides, but first, we have to go through the disclaimers. This production is part of 8% Value Activist newsletter on 8%pa.substack.com. All rights reserved. No part of this publication may be reproduced, distributed, or transmitted in any form or by any means, including photocopying, recording, or other electronic or mechanical methods. The information contained herein is not and should not be considered investment advice, nor does it constitute an offer or solicitation to buy or sell any securities or financial instruments. The content is for informational purposes only. And you know what? In short, this is not investment advice. DYOR, don't sue us. You will be up against AI. Let's get to it. Okay, so why did we like Warner Brothers Discovery? That's because we believe it has one of the best content library globally, with iconic franchises like Harry Potter, DC Comics, Game of Thrones, and others. It also owns many strong media brands like CNN, HBO, Discovery, and more. The only rival is Disney, and while Disney traded at around $200 billion market cap, WBD was trading at a fraction of Disney's market cap, around $20 to $40 billion. Warner Brothers Discovery is also a strong free cash flow generator with growing EBITDA. That is in the red box we highlighted, and so we thought this was a hidden gem. What's more, Disney was subsequently engaged by activists, and that implied the whole media industry could become more interesting. Well, it was a long and arduous journey holding the stock, and yep, things finally turned for the better this year. But it was one hell of a financial and emotional roller coaster ride. And yes, the gory details are coming. So here's the whole story, including the gory details. Warner Brothers Discovery, or WBD, was formed when Discovery merged with AT&T's media division, Warner Media, back in 2022. We studied Discovery back in the days before the merger, when it was a must-have channel on cable TV for dads and granddads. We liked the story, and when we saw how Discovery would inherit the whole Warner Brothers content library, we were excited. Alas, when WBD was formed, it took up $66 billion of debt, and its main cash cow business, cable TV, was declining. It was called cord cutting. Netflix and streaming was the new thing. Everyone cut their cable TV subscriptions, so the stock bobbed up and down violently between 2022 and 2024, contributing to poor portfolio performance. Long story short, in June this year, WBD announced to split into Growth Co. with streaming, movies, content, and all the sexy businesses, and Legacy Co. with free-to-air TV, CNN, Discovery, and other less sexy businesses. The market liked this, and the stock finally started to outperform. Last week, 12th September 2025, Wall Street Journal leaked that Paramount Skydance, controlled by Larry Ellison of Oracle and his son, is preparing to buy Warner Brothers Discovery. This was a major surprise, and the stock shot up 40%. So, thanks to Larry and David, the stock made 126% profit for the portfolio. In this graphical slide, we describe our agony and pain. When we invested, there was the hype of the Max launch. We made money and thought we were geniuses. Max was WBD's streaming service to rival Netflix and Disney+. But Max did not do well. Cord cutting turned further south, and earnings downgrades came in waves. Like tsunami waves. We saw our position bled, and it just continued to suffer as market cap collapsed in half to $20 billion. In 2024, there were more twists and turns as depicted in the purple boxes. At times, we watched Shawshank Redemption on Netflix to remind ourselves that we needed hope. Hope is dangerous, but hope is also perhaps the best of things. By the way, that's my name too. I am Hope on 11 Labs. So, finally, we got vindicated last week. Yes, content is king. People pay up for content. Thanks, AI Hype, Oracle, Larry, and David. We love you. Next, we move on to the lessons learned. Okay, so what are the lessons learned? I believe this is the most important part of every bet, every transaction, every investment. We learn and take away lessons from the good and bad investments so that we can be better. I think there are 3 important lessons here. First, it is never a good idea to buy heavily indebted companies, but we thought this was compelling enough to take the risk. Well, it worked, but it could have been equity dilution. If that happened, we risked permanent loss of capital. So we need to be super sure next time when we invest in high debt companies. Second, we must be mindful of businesses in secular decline. Cord cutting was serious for Warner Brothers. It was 70 to 80% of its earnings, but we overwrote that in our monkey brains that content was more valuable. The reason why Disney was almost 10 times bigger was because Disney could monetize its content extremely well via its theme parks, Disney stores, Disney Plus, and blockbuster movies with sequels and trilogies. Warner Brothers did not do that, although in recent years, they seem to be starting to get things right using Disney's playbook. And lastly, we should always size the bets of such difficult stocks appropriately. WBD should be a mid-sized position and not one of our largest bets. Yes, some investors do like high risk, high return. Bet the farm is. However, for our team, we hope to focus on multiple mid-sized bets on free cash flow generative activist stock ideas going forward. Warner Brothers Discovery is an interesting investment case study. We took profit but still have a small position as the situation is live and things could change. We hope to time our final exit well. WBD was not exactly an activist name per se, although its arch nemesis Disney is. As alluded to, 8% Value Activist monitors shareholder activism, which is coming to Japan and Asia. We hope you have enjoyed this video. Please follow us and subscribe. Your generous support is greatly appreciated.